All right, I am here with Rob Pieklo, as he taught me how to say that a long time ago, and he's right. I have not forgot how to say your last name. I hope I got it right. But Rob, we're talking today secondary market, really breaking it down, making it easier to grasp and understand. A lot of the community doesn't always get how rates move, how the market moves. How does it really impact the broker community? And you are here today to talk us through and explain it to us every step of the way. How are you doing today?
Oh, doing awesome. So glad to be here and finally get this session off the road.
Yes, sir. Us too. And we know there's a lot here to unpack, and we want to really make it bite-sized pieces for the broker community. It was a huge area for Rob and AFR coming in. This is the area they wanted to own for AIME. And a matter of fact, it's something very close, near and dear to Rob's heart. He spends a lot of time having conversations with the investors, getting the money their way or our way to pass it on to you, the broker community. And he's got to make sure it makes sense for all parties. He's got to keep himself and his company happy. He's got to make sure he's delivering a great product to us on our side. So let's just get started, Rob. Rip the first Band-Aid off. What makes up the pricing of a loan? Let's break it down, conventional and government, because there are nuances.
There are, and it's one of those things we want to push this out to the broker community because we know, like a lot of times, this kind of stuff is kept behind the curtain, and it's for us, it's easy to make up our rate sheets and kind of keep everybody in the dark of what's going on. But we're really trying to be transparent about this and how this works. So we find it's actually stunning how few people in our space don't know how this works. Yet we sell this stuff every single day. You ask somebody what happens, what makes up a price of a loan, what happens after a loan gets sold. And there's so many things that happen with a loan that originators just don't know. And I think pricing is one that it confuses the heck out of everybody. And it's really not that hard, but there's different components when it comes to pricing. And I'll use two examples. I'll use like a conventional loan as a baseline example. And you may open up a rate sheet and see this long, crazy, a rate stack, as we call it. And it has all these different note rates with different prices. And sometimes it makes sense. Sometimes it doesn't make sense. On the conventional side, you basically have like your mortgage-backed security price or a cash window price. There's two ways to deliver to Fannie and Freddie. A lot of companies use what's called the cash window price, where there's just a price for the loan itself, the what's going to go into a security and become a cash flow for somebody who's going to purchase that type of bond. And there's a loan price, and then there's a mortgage servicing right price. Those two things are combined into a full price or value, raw price of a loan. And then you would take the margin that the company is looking to make. Now, I'm one of the few people that speaks pretty openly about margins. Margins are not great in our space at the moment right now. And things we'll see if things get a little bit better, but you see it in the news, you see it in, all the earnings reports that are out there. But margins are pretty tight right now. So your pricing, right, how it stands today is pretty close to the raw pricing and what you're seeing out in the markets as a whole loan package, because our mortgage margins are running, relatively light historically. But let's use an example of 6.875 on a conventional loan today. If you looked at our rate sheet for us, it would pay 102.408. So 2.408. You can say that a bunch of different ways. We can say it that it pays 2.408%. We can say it pays about 240 or 241 basis points. But that combination, the loan price itself, like the bond itself in the background, the security, I should say, is only paying 101.558. Okay, so that security itself is paying 101.558, and the mortgage servicing right is valued at 1.25 or 125 basis points. And then we have a margin of about 40 basis points total. So you would have, the raw pricing of that loan at 6.875 would be at 102.808. And then you take our 40 basis points of margin. And on the rate sheet today, we're putting out 102.408. So you have your MSR component, which is your mortgage servicing right value, and then your loan price component. And what a lot of people don't understand when it comes to mortgage servicing rights, that isn't a cash value. So it's a non-cash item, meaning that mortgage servicing rights.
On your
You
books, they
have to
look,
put on the
yes.
books. It's future cash flows. It's not today. We'll get that into a second. We'll get into that in a second. So it's a big chunk of what's going out in pricing is kind of hopeful. We're hopeful that it's going to come in. It's modeled out that cash flow is coming in, but today it's not cash. The security price, that 101.558 we talked about, that we receive in cash, but the total value of the loan has those two components to it, and a lot of people don't know that is how that pricing is derived from. Now, government, it's similar in nature, where you have a loan price. We'll use 6.5% today on a government loan, an FHA loan. We'll use that as an example. And the loan price itself, like what you're going to get for the loan, is 101.31. And then the mortgage servicing rate on that one is going to be 1.734. So about 173, 174 basis points for that mortgage servicing rate. And then with that same lower margin of about 40 basis points or so, you're going to see pricing on that government loan to be at 102.644. And these are all as if you're pricing at a borrower paid compensation. So there's no lender paid compensation in these. This is just the raw price that would show up on a rate sheet that you can see every day. But that 6.5% note rate for a government loan has the combination of your loan price, and then has your mortgage servicing rate, and then the margin in there. Now, with government loans, it's a little bit different than conventional loans because the servicing can vary a little bit, and we can get into that in a second when we start talking about MBS and the fun stuff about coupon slotting.
Well, so here's what so y'all, I'm taking a lot of notes. If you can't tell, I'm typing away. I have a pretty decent overview. I like to say, in terms of my understanding, I feel pretty confident in it. But whenever you can take it to the next level, it is important. I'm more of a visualizer, so I like writing it out, and that's what I'm doing now. So what Rob's talking about, y'all think about this. You click that button, whatever LOS, whatever pricing engine you're using, you click on AFR, you hit it, it opens up, and it shows you this massive list, right? The rate stack table that we have. Rob, you talked briefly that the margins for lenders across the board are pretty much, I mean, you're seeing 30 to 40 right now as pretty standard when you look at companies that are publicly traded and looking at their earnings reports. Do you know why it's how that's changed between now and the last 5 years? Were people making more money several years ago on servicing, and how has that changed currently?
Yeah, so in general, there was more money in the loans. There was more premium back in the day. I say back in the day, but COVID is back in the day now, I guess. But post-COVID, it's very interesting. I've said this on some podcasts before, but it's such an intriguing fact that when you looked at the MBS pricing for the securities themselves, back in 2021, we'll even say the lowest paying coupon, the lowest, like the worst you can do on a production coupon, was paying about 3% or 103, 103 and a half. Okay. Was the lowest. Today, the highest you can get, you'd be scratching and clawing to get to 102.
Wow.
So you had the opportunity to have 103 is the worst you can do, and then things paid 106, 108. So yeah, mortgage companies had more margin because there's so much premium to be had. The volume levels were, doing 4.5 trillion in loans. People widened and made a lot of money at that time. That's fast forward. Now we're at $1.4 trillion market, and premiums have compressed significantly. So you're not seeing as many buyers and pushing the premiums up, and you're seeing that the overall amount of money you can make on a regular loan. There's all these other ways to try and get better execution that we pass through. But in general, it's hard to get a lot of premium. It's not easy to be had. And that's also why you've seen retail have to make a huge shift in how they price, because they lived in the higher premium world. They lived in higher margins. And now it's funny, they were so uncompetitive for years because that extra 100 basis points of margin they had in their loan, it was easy to get to before, but today it's so hard to get that extra 100 basis points of premium. You have to go up almost a full 100 basis points in rate just to get it, which has never been the case in the mortgage market.
This is so, I know we're going to deep dive into MSRs here in a bit. This is super fascinating on our side. And one, I hope brokers out there, you understand that this is This is about the understanding of the market, understanding of why pricing moves the way it does, and then also understanding that there's little things each lender can do, but there's not much, right? It's pretty standard right now. It is starting to get better, but you're basically holding these servicing rights in hope. So Rob, your team's hoping that this is working down that road. But let me talk about LLPAs for a moment. Is us seeing a shift in these LLPAs over the last 3, 4, 5 years? You saw certain things such as second home LLPAs increase quite significantly. Obviously, people know about the broker surcharge that we have on our side. How do you have those conversations with Fannie and Freddie, and what are you looking at when it comes to LLPAs specifically?
I usually look at their incredible profitability. So
Can you
like they're
tell the
not
people
struggling to make a
where they're
profit.
at? Can you just let
Yes.
people know?
Yeah, they're making billions, but it's quarter after quarter. So they're Fannie, I think, is at like 28 consecutive quarters of profitability. They have not seen any down swing in margins or that. So they control a significant amount of the market. Obviously, Fannie and Freddie have been profitable for a very long period of time, even with stuff on their balance sheet. But in general, loan level pricing adjustments is just one piece of the component. However, it's based on administration and how to and what they're trying to do with the GSEs. LLPAs are a driver. It's supposed to be an insurance policy based on delinquency. What on risk? Like, what is the additional risk of this type of loan? And it's very, very clear if you look at the delinquency data, that is not the case, right? That's not the case. It is. They just don't. Like they don't default. Like, can you really show me the data, the difference between a 780 FICO and a 740 FICO on a 20% down loan? And why is there any LLPA on it? I mean, the delinquency rates are minuscule. So the LLPAs were created in a fashion to bring in revenue to cover risk just in case. Now we're at the point where these things are performing. It's the best credit quality at the lowest LTVs and the lowest DTIs ever. Right, ever. So when you talk about securities that have been created, you've never seen a better quality. So yeah, we talk to the GSEs all the time. We talk through that. Now, I will say this administration and this kind of new regime, it's going to be very interesting because of what they're trying to do, and then what they're saying they want to happen are two different things. Right
Can you
now,
explain that? Yeah, please.
yeah. So you hear a lot of like privatization of the GSEs,
Yes.
but still have an explicit versus implicit guarantee on the loans. It's very difficult today to privatize the GSEs and not raise pricing or make pricing worse, raise rates.
Can you break that down for us?
Yeah. Well, today, on a regular conventional loan, like Fannie and Freddie are taking 90+% of that particular market. If pricing was in a spot where this could be privatized and the money from the outside would be coming in without the government guarantees, you would see more loans being won by banks or other places. Like there'd be money coming in and would price better and more competitively than Fannie or Freddie. There is one area that you see it, and that is in the massive LLPA range. So if you start looking at second homes and investment properties at slightly higher LTVs, they have pushed LLPAs so high that you're starting to see the private market come in, and like we sell our investment property loans elsewhere outside of the GSEs to get more premium, and obviously pass that through to the broker channel. But so we've started to see execution there. But it's the regime itself. You would they want to see rates get lowered. So to say like, hey, we want rates lowered, we want Jerome to lower rates, and we want mortgage rates to follow suit and go lower. It's very difficult to do that and privatize the GSEs, just because you're going to have some kind of increase in fees to get the private market to kind of like what's going on at Fannie or Freddie. So the LLPA discussion is an interesting one. We know it's a cash cow. We know they're making a lot of money off the LLPAs. We know there's no rhyme or reason, and in fact, when they changed some of it on the higher end LTVs, they tried to help subsidize mortgage insurance payments, which a lot of times you see like, oh, why is it like less, a little bit higher than on LTV perspective? And it was because they created LLPAs and made some tweaks at the higher LTV levels to help with the cost of MI, especially on the lower FICO borrowers. So they use it as a method to kind of pass through and kind of use it as an agenda item for the regime. But I would say this one is a little bit different. They're trying to shrink it a little bit, get a little bit more aggressive. They want rates to be lower. So you could see, and LLPAs are a huge discussion with the GSEs. We know, Pulte has been vocal over rates to come down, and talking through the LLPA grids is one of the things that they'll be attacking probably in the next few months, and hopefully making some changes that are in there that would be good. But there's one component that most people don't know about in here, and we talk a little bit. We have servicing fee, and then we have this G fee, and a lot of people don't know on conventional loans. Every one of your loan has a subsidy in it also. So you talk about LLPAs, that's one small pricing component. Most people don't know that if you do a regular loan, there's over 50 basis points to rate that goes to the GSEs on every loan. Every loan. So you might see it, and you might look at MBS Highway or MBS Live and look at a MBS coupon, and you're like, oh yeah, like the 5.5 coupon is doing this today. That's not 5.5 note rate. You have to add servicing and G fees to that. So it's a mismatch. But in general, for us, and what we've been talking to the GSEs about and asking for is, yes, revamping of the LLPA grids to pricing, but like, hey, let's take a look at these G fees. No, the G fees have never gone down, and in history. And when I started in the business 100 million years ago, they were only like 10 basis points, 12 basis points. And today they're like upwards of 55, 56 basis points. And I use 50 to make it easy for math, but it is a significant tax on home ownership and home financing in general. And people don't know that.
So I have a few questions here to unpack, if you're okay with that, because you just gave us such a big punch there, in my opinion. And here's why. The first place I want to start is the importance of what you said that I love. That explains why we see some lenders, when you price out second home or investment, you're seeing them price significantly less. Your companies like yourself are literally going to find other investors saying, hey, can you buy these for us a little bit cheaper than so-and-so would? Here's our default rate. It's really low. We have a great client for you. Is that somewhat of the conversations you're having?
Exactly. So
now,
I'm aggregating.
How do you go and find them? How do you put those bids out to build this up? Because that's something that I don't think a lot of the community even understands.
Yeah, so we go ahead and we basically run best execution out there. So once the loans are completed, we have them marked a certain way. We go out and we take our loans and package them up and say, all right, let's put them out to bid also. Like, let's take these loans that have higher LPAs and or something that would be a little bit elevated in coupon, and put them out to the market and see if somebody's willing to purchase them. And obviously, we're not going to strangers. We're going out to institutional investors and significant, like giant companies that have money to put to work. And then they'll bid on these things. And basically what we did first, and we're one of the first companies to do this, was we went out there first. Like, we went and started talking, and like, we talked the big game. We're a small wholesale shop, but we're like, we can bring in blank amount per month. We can do this and that. If you just give us this price, can you lock in a price that's this good? And they agreed. And then we found a way to pass that through in our rate sheets by adding. So we'll price to Fannie or Freddie and then add some things. That's why sometimes we'll go through and you'll see, like, I'll use us as an example because we're ahead of the game on a lot of the investment properties. So we're going to make 60, 70 basis points through somebody else. So we're going out and we're taking that pricing. And what I could do is just put it in as standard Fannie or Freddie pricing, hope to get it in, and then turn around and sell it and make more profit. But to me, I want more loans. So I'm taking that, taking my baseline margin, being comfortable with my margin levels, and taking that gain that I would have had, and I'm passing it through on the rate sheets so that way I can get more of it. So I would much rather make my standard margin on a lot more loans than make a little bit more on a smaller amount.
And it does make sense for those that, if you're not signed up with AFR, I highly recommend it. They've been an incredible partner, not just for AIME, but for my company personally. We were recently absorbed by NerdWallet directly. So NerdWallet mortgage experts, we've been leveraging them quite a bit, and we saw changes right away. This is several months back, I believe, at this point, with the adjustments you guys made. But this is the type of stuff that gives you it's not even the edge. It's the how do we make this an opportunity for brokers to keep even winning, right? Where companies like yourself are going out, like you said, we're a small company. We puffed our chest out, said we'll deliver as much as we can. Now, for someone like you conversating with Fannie, obviously a lot of the brokers, I love you, but we can get aggressive sometimes. We talk to underwriters a certain way sometimes. We talk to you a certain way. I've seen it, and you've been replying accordingly. But when you talk to Fannie, obviously you can't just come at them hard and just hit them between the eyes and here's what we need and you're doing this wrong. How do you start the conversation with them? How do you open up the door? How do you articulate yourself in a way that probably to you sometimes can be frustrating because it's I assume sometimes it falls on deaf ears. They're making hand over fist in terms of money. How do you start that conversation? And what would you recommend we do? How can we help? How can we post about this? How can we talk about it in a light that's not aggressive, but hey, we have questions and concerns and we'd like to know why?
Yeah, well, I actually am pretty aggressive. I
No.
was laughing because I was like, no, I bring like that broker piece
Yeah.
to those emails, like in a typical way. I'll do like, well, I know guys have been really struggling financially, so I understand why these LLPAs are so high. God forbid you don't make money for the 29th straight quarter. I may start a conversation like that. I actually do. They enjoy it. They laugh at my the way I chat with them. But so we bring in facts and we bring in data and we talk about what the community is. And for me, I having access to so many originators across the country, we have like immediately, if there's something that we can do and offer, we can get out to everywhere. Versus if you're a smaller retail shop and you're like in a certain region, you just don't have access to a network. Now, granted, I have to fight like tooth and nail for every single loan. But for us, it's like when there is something to be offered or something we can work with them on, and if we can get into a pilot or get into a program, we want to do it and offer it out to the community. So when we have something like this, and the best part about this whole non-owner and this investment piece, like we kind of started a little bit of a trend. Some people are following suit of what we're doing. But talking to Fannie or Freddie, it's hilarious. They're coming back now and like, well, can we also bid on those? So you're creating this true capitalism of the mortgage market again, versus it being just totally subsidized, taking in, just nowhere else to go. Now there's a market, and all of a sudden it's like, all right, well, yeah, we'll go ahead and send a bid over to you guys. It's kind of weird, but we'll do it, and they'll bid on those as well. So it's a capital markets function. It's going out there and talking to them and saying like, hey, this is what's needed. And then they come back and say, hey, you used to send us this amount of non-owner. It's gone down a little bit. Like, can we get that going again? So you're having those conversations with them. But we just provide the data. We're very, as I am in these calls and with brokers, and so good, bad, or indifferent, I'm very transparent. So I don't hide the fact that I'm putting bids out. I've let them know. And if that means that they don't want to compete or they don't want me as a customer, so be it. But I'm going to tell them the truth versus turning around and like sneaking around trying to sell off loans. There, we have an incredible profile. We serve the affordable community and the underserved an amazing amount. We are double their marks of where they want for lower income and very low income production. We are there. Our profile is fantastic, and we're a very good partner. So, we have great conversations. They do like us. Obviously, we've seen growth. I mean, geez, I think we purchased the company, conventional loans. I think they're doing like 3 or 4 million a month of it, and of conventional in total.
Yep.
And now we're pushing, doing 175, 180 million of conventional volume a month, just from that side of it, and continuing to grow because people still don't know we do regular loans. Like people still think we're just the specialty and niche product. So we're getting there slowly but surely. But it's just funny to see that kind of growth. They see that growth, and they want to partner with us because we know that the trajectory is going in the right direction for us.
I always love to. So for those that aren't in our Facebook group, Rob does a fantastic job addressing every concern, good, bad, and ugly, and he does it in a very, very, very good light, and always taking responsibility. But it is very fascinating to me that people don't always, a lot of the problems up front were these crazy wild loans that like they're trying to, no offense brokers, some of these loans I read, you're trying to throw something against the wall and then you're yelling at the lender. And fortunately we got people like Rob who can address that and handle that. And here's my cell phone number. Give me a call. I'd love to talk to you and walk you through that. I do have a question. I don't want to put any words in your mouth, but just based off of where you're at now, before we move into MSRs, and I have several questions there, but with the privatization and the potential there, Do you right now, with the information that you have and what's in front of you currently, and I know things will open up, do you believe that the pros outweigh the cons currently, or is there more that you have to see before you're like, I'm not, could be a little dicey if we go down that path?
Yeah, I think it'll be dicey if we go down that path. I think
Okay.
they'll come to the realization that we could not, in a fragile housing market as it stands, we don't think that doing this makes a lot of sense in the short term.
Okay.
So, I think the administration will see that. I think they're going to try and talk through, and they'll have some experts. There's some good people that are giving some guidance around this and have an understanding of how it works. So I don't think it's going to happen quickly. There's just too much of a capital raise need of it. So I'll keep it short with this one.
Please.
But like to have it privatized and go back to the public market, I should say, in general, from the stock perspective, they would have to raise, from where they are on the balance sheet now combined, like they would have to be worth about 350 billion or so. And they would need to raise about 200 billion then. And the largest IPO, I think in recent time, or the largest ever, was Saudi Aramco. And I think that was like 27 billion.
So you're
So
talking
we're
almost
off by
10x.
quite a bit. Yeah. So you need this significant amount of capital, and there's different ways to do it. But like, you have all these different share types, your preferred shares and regular shares. It seems like it'd probably be better for them to slowly gain more on their balance sheet, keep printing every quarter, and every couple billion that they make is a couple billion they need to raise to have the proper capital there. So do I see it happening soon? I honestly, I don't. I think it's mathematically nearly impossible. But I would say that it is something probably they're going to really try and figure out before the end of the administration.
Yo, Joe, just to think about what he said $200 billion to raise, and the biggest IPO we've had in recent years was 28 billion. You're talking almost 10x to bring this to light. So this stuff is important. Why is it important? Well, multiple reasons, but the big one is, focus on your business, right? You can see that there's a lot of people involved on this. You can see there's a lot of people that are behind the scenes trying to understand it and grasp it more. Don't let this stall you out. Don't let this, I'm waiting to see if the market moves. I'm going to wait to see if they privatize this. Even if your clients bring up stuff like that, move away from it. To his point, there's people figuring this out behind the scenes. The show must go on. Now, with the show going on, Rob, one of the areas for me is, we're getting good at that, Tommy. I know you're behind the scenes, my friend, but we are learning transitions very well. With that being said, one of the areas for me that I believe I'm just fortunate to be a part of is with our recent acquisition with NerdWallet. I deal with a lot of marketplace clients now. And what I mean by marketplace is we're seeing retail come back swinging, Rob. And I know people are going to say, well, John, no, brokers are priced always better. However, they have something that the broker community does not get access to, which is the ability to leverage their MSRs and ability to generate cash through MSRs. And what we're seeing now, Rob, is I have retail lenders that are aggressively pricing better than me. And in some instances, based on the profile of the client, because we'll get some very high qualified clients, they're getting to a point to where I can't even touch it. Even if I choose to lose money, even if I do the loan for free. And can you explain how they're leveraging MSRs in retail to set themselves up? Which, by the way, from a business standpoint, y'all, I'm not saying, screw retail. I'm not. I'm saying it's a smart strategy that we just don't have access to. Can you explain what you're seeing now from retail?
Sure. There's a couple components to it. So one, just in general, MSRs, like we talked about before, are they're not cash. They're cash. It's future cash flows. Now they become cash as it comes in, and how it works is you basically set a mark as a value to it because there's cash flows that are going to be coming in. But if that pays off, there was nothing. You just lost money because you marked it at a certain level, and it pays off. Then that whatever you marked it at, it becomes zero. There's no more servicing rights. So if you implied that there was going to be a 7-year life of that MSR and it pays off in the month 6, it just becomes zero. It's different than mortgage bonds when you invest because you get your principal back at least. Like if you're looking to do it, and you're looking to earn a return on a certain amount of money, at least when you invest in it, you're getting that return, you're getting that principal back in that investment. And these are across obviously large aggregates of loans, or an aggregation of loans, I should say. So for the servicing right, there is a way to value servicing, and you take your future cash flows, you take your delinquency rates, you take your implied losses, and you do all the math of that and come up with a figure. You come up with a number. What's happened in recent years is that you're starting to see people, especially those that retain servicing, are valuing that servicing right, or the ones that are buying servicing too,
Yes.
in mass, that they're implying that they're going to get some recapture or refinances of those loans in that MSR value. So they're implying like, oh, you know what, I'll pay, a 5x or 5 multiple on the servicing fee today. And then maybe someone else comes in and goes, well, I'll pay 6 because I think that I'm going to be able to get 2 or 3 refinances down the road off of that one customer if it's in our platform. So retail, and I say retail, there's a lot of distributed retail companies out there right now that like don't do this, right? There's a lot of ones that are just selling to aggregators or selling to the pennies of the world or whatever it is, AmeriHomes, and they don't have the opportunity to do this either. But the retail, the larger ones and the ones that are making the news all the time, that servicing right, there's an implied value to what they're going to recapture. They're going to take a client. They're going to take a client, they're going to refinance it, and you're going to see it, and whatever opportunity there is for that. And the reason that they can price so aggressively is what I just talked about before. There's an MSR value. And you go, like, if you think about from a math perspective, if you're sitting there and let's just say the MSR is worth $1 or 100 basis points. Okay. If it's worth 100 basis points and it pays off tomorrow, and if you're valuing that at 100 basis points, come quarter end, you have to say, or month end, you have to say, all right, I no longer have that servicing right. So I lost 100 basis points. So now when you're trying to keep that servicing right on your books, or your retention of a retail shop or a retail retention group, you're looking at that MSR and you go, man, I'm starting that if I don't do this refi, the company's going to lose 100 basis points. So any amount of revenue, any amount to keep that servicing on the books is going to be a value add. It's going to be accretive to this for our month, for our financials. So you'll see somebody, they'll go in and like, yeah, they have to match something or beat it to keep it on the books. They're not pricing like that to start. They're pricing that in this competitive piece of saying like, oh man, I may lose this servicing right. And when you lose servicing rights, like I mentioned, when you buy servicing or originate servicing, like that whole value isn't cash. So if you pay for it, you're outlaying cash. So if I paid you $1 for it, and now it's potentially going to pay off, and I can't get that dollar back. We can talk about EPOs and why there's EPOs in a second. But if you paid that dollar and I'm going to get made whole in like year 4, and then start to profit on my servicing right in year 5, and you're going to pay off next month, like I need to refinance this and put a new MSR in to make up for that MSR I'm going to lose.
So let me ask you that question then. You maintain and retain the servicing. Does that is that like a reset the note? How does that work when it comes to, hey, the payoff for this? I know we said 7 years. I'm going to keep it in house. I know it's being done within 4 years, for example. We don't want to lose the full 100 bips. I just want to do it right now. Does that reset there, or are they just taking that loss on whatever they lost and they're making the money on whatever it is to retain the servicing rights?
Yeah. So in the accounting world, you'll see a negative mark for the value to go down, but then you see a new loan, which is the same person, but the new loan come in and take that value spot. So basically for the month, you net whatever the additional margin is above your MSR value, but you may even put it in and have a higher MSR value, because if you lower the note rate of a loan, if all things were equal and you had a 7.5 note rate and your MSR is worth $1, if you put that loan back in at 6.5, that MSR is probably worth $1.50.
Got it.
It's because it's worth more because it's a lower note rate, less chance to prepay, and that
refi. Yep. No, it makes so much sense. It especially makes sense why these companies are buying up servicing, especially companies. Yeah, look, I don't. Hopefully at this point, people know I business is business. I believe, companies are for profit. That's just my belief. I don't believe companies are out to, just make things easier for everybody and make no money along the way. That's just not how I believe, especially in the mortgage space. But you're seeing a lot of companies buy up servicing rights. You're seeing a lot of huge retailers, buy out other companies. And look, there's an idea there, especially these companies that have incredible recapture rates, companies that know how to get on the phones. That's the environment I grew up in, just to be very upfront here. it's hammering the phones. It's not letting the client leave that ecosystem is a really big deal. And the more AI advances, the more all this starts to come to light, it'll be harder for them to leave that ecosystem. And so just understand that. I'm not saying that's good or bad. I'm simply implying that this is the next wave of what we're going to see over the next decade, at least in the mortgage space, especially as technology starts to rise. And if margins don't open up and lenders are at a place to where 30, 40 is the normal, and hopefully it's not, because it's better for us just to be upfront with you when this starts to open, you just got to be prepared for it. Now, Rob, talk cash needs when it comes to the MSR side of things, cash needs when it comes to servicing. How do companies generate the cash from this side of it? What do they do to, okay, we're going to generate all this money. We're going to be able to get it, bidding, whatever the case might be, and we can spend it on X, Y, or Z. How does that work, and when do you actually make that decision as a lender?
Yeah, so everything I do on a day-to-day is based on cash, right? So I'm working the loans. I'm looking at every single day where we are in a cash position, how much we're going to invest in MSR, retain, sell in the future, do mini bulks. Am I going to sell immediately? And there's different ways you can sell MSR. You can sell it right at closing through what's called or at funding at a co-issue. You can do a intermittent kind of like mini bulks, which is every 3 or 4 months. You kind of sell what you've aggregated, and then you can do bulks. You can sell them that way, where you take up a year's worth. You see a lot of the big wholesale lenders will do these huge sales to generate cash. The reason they did it was, again, going back to the fact that you've put in a significant amount of your pricing is in this non-cash item. So a real simple example is, and we talked about the margins. Let's say margins are, just for math purposes, it's really easy. It's 50 basis points. If I'm making 50 basis points on the loan, let's pretend like that's a reality and we're able to net 50 basis points. That's not the case, but let's just say we can do that. And if I'm pricing and I'm paying out a 102 for that loan, so 2% for that loan, and 150 basis points of that is your MSR value, okay, a non-cash item, I'm underwater 100 basis points in cash to do that loan. Okay, so you may see a profit in a GAAP accounting world, it's profit. So it's because it's implied. But if I do the loan and make money on that loan, I'm still out 100 basis points in cash. So $200,000 loan, I'm out $2,000 in cash. But I do have this thing that's come in and has 150 basis points of value, or 125 or 100, whatever the value of that MSR is. But for this purpose, we'll say 150. If it's 150 basis points in value, you do have that. So, you're pricing it, you have that in there, but I have to have enough cash to like keep the lights on and make payroll. So then you have to figure out, like, am I going to sell this MSR and receive that amount back? So put out to bid. Or do I want to borrow against it potentially? You see a lot of people, big names out there, have taken on debt against their MSRs or created debt vehicles for their MSRs, since it does have an implied value. So since that value is there and it meets accounting standards for a value of something, you can then borrow against it, just like you would stock or anything else. You can just borrow against the value of those MSRs at a certain LTV range, just like a borrower would borrow against the house. So if you have $1 billion worth of MSRs on your books of a value of that, and you want to borrow, you could borrow 500 million against that $1 billion of MSRs, and you have to navigate that every day. So you have to see where margins are. When margins are wide, it doesn't matter. Like, when you make a lot of money, if you make more money on a loan than the MSR value is, then you're okay. You're net accretive to your cash balances. But when it's not, when it's under, which right now, there's very few loans that are making more money than the MSR value, when you're doing that. So when you have that, it takes a lot of cash to run the business. So this is why you see companies sell MSR, and you're like, oh, why'd they sell? As a client, whatever. They have cash needs. Like, they have things they have to pay for. They have debt they have to pay for. So they have to sell sometimes to get that full value of the MSR in cash to then do the things that they want to do going forward and invest in the company or invest in different things. So that's where those cash items go. And it's something that, we'll wake up every single day. Like I said, it's a main focus, and most mortgage companies in this environment are in this liquidity and cash focus to make sure they can run the business. Because when the market moves, and we'll go over that in another session, but when the market moves, you need to have cash on hand in case rates get better. It actually costs mortgage companies a lot of cash for your hedges and whatnot. So you need to have that liquidity on hand, at all times to make sure that you're meeting all your covenants for all the, government agencies and warehouse banks.
I'm the reason I'm smiling, Rob, is I feel like all of us out there, if you ever meet a capital markets person, give them a hug. I think they need a hug right now. I just saw your face. Like, all right, every morning I wake up and I got to make sure the cash is like, imagine, and I'm not saying one stress is, more stressful than another. I'm simply implying that from a capital markets perspective, when the margins are this thin and you got to make sure the cash is there and you got to make sure everything pans out. My only guess would be it can be stressful. So if you meet somebody that deals with capital markets like a Rob, maybe tell them thank you. Maybe give them a hug. Say we appreciate you very much, because this
is the same thing. You want to run it. It's just like anything else. Like if you're a fund and you've raised capital and you have capital, you don't want to sit in cash.
No,
right? Cash keeps going down in value. So like it's not a thing of like you want to have a little bit of extra cash, so you do it, but you have to manage your business to be like, all right, if I have this if I had 50 million of surplus cash, I'd be doing a disservice to our investors and our fund, because that money's not working. So you always want to, that's why we wake up, no matter what condition the company is in, no matter what, a position it's in, you always want to keep cash in a balance level that it's not just sitting there decreasing the value of what you're doing. I'd rather put it to work and buy MSRs or buy more loans and get more loans done and put that cash to work and make a return on that, or the return of equity on that cash.
And to your point, I know it's not like it's an everyday thing, but basically you're on show every day, right? For you, when you wake up, it's like, I have to deliver, and my delivery is based off of the decisions that we make, based off what I see. I'm sure the volatility has been quite fun navigating as you go through this pass. And I'm sure there's been opportunities and times where, hey, we might've lost some money here, but we're winning more than we're losing in that instance. And that's the tough decisions that you're stuck with making. Not stuck, I think privileged to make, because the industry so well. That's the wrong word. It's a privilege where you enjoy it, you embrace it, and you know how to navigate these waters and navigate the stress. One of the stress for mortgage brokers, God, I did it again, Tommy. See, we're on here. One of the stress for mortgage brokers, EPOs. I know we've driven this point home hundreds of times, and I understand why it falls on deaf ears. I really do. Mortgage brokers, we're talking in money, you put food on your table, but it's really important that we make the world go round. And it's really important that everybody does their part, especially because of where we're at right now. What have you noticed, Rob, with EPOs? How do the conversations go with mortgage brokers? And what would you say? Do you have any advice or tips? What do you see happening over the next couple of years with EPOs?
Yeah, well, luckily and unluckily that we're in an environment, there aren't as many as there could have been, right? Because rates are elevated. So with rates being where they are, it's something that's going to be very interesting with all the things we've talked about, advancements in technology, AI, retention groups, how fast they can refinance, how fast people can try and get a client in general when rates dip. Like brokers themselves have to make those decisions and figure out if it's something that's going to take an EPO. So, for us, the conversations we have, my favorite ones are the ones that want to come and work with us and figure it out. Like, hey, I got notified. This is what's happening. What should I got a great call on Friday. A shitty call, but it's a great call, because they called up and said, hey, I just found out, like, customers paying this thing off. What do we like? What can we do? When I get that call, I want to figure out any which way we can figure out where it's not going to cost the person money, right? Like how do we figure this out? Let me take a look at this in general, because you get that heads up versus burying your head in the sand. The thing pays off. I hope they don't get, we see everything. We see it all. We know when things pay off. We know that there's an opportunity to get back, based on the contracts. Like, you see all of it. We want to have good partners in that. We're not out there to, this isn't like, what is it? Scrooge McDuck, trying to get money and like trying to figure out a way. Yeah. Like we're not trying to like get more gold coins here. It's simply the fact that, we've just talked about it. It's not just paying out broker compensation, because even on BPC, you wonder why a lot of places do have a administrative charge, whatever it is. It's because what we just talked about. We just talked about the fact that we have created an MSR and created a ton of our pricing has a value that is not cash. And we have to outlay that cash. So when a loan pays off early, we get hit with a charge. Like, we get hit both from a accounting perspective. And if we had sold the MSR, whoever bought the MSR is going to ask us for that money back. So,
Wow.
oh yeah. So the MSR, you have to pay that. Usually they're, 3 to 6 months, depending on the contract you negotiate. And usually it's a few months in to our already funding the loan. So you may be at a different timetable as the broker in the agreement. So sometimes you just wear it and take a loss because you're past the agreement time. But there is significant losses occurring for us. Sometimes the GSEs can come back to us for the premium as well, for the security or the loan itself. So there's different things that happen that cost the lender money. And when someone says, oh, this lender doesn't charge us for it. No, everybody does. They may not send you a bill, but it's implied in their pricing models saying that there is a certain amount of payoffs that are going to happen. There's a certain amount of loss that's going to happen on these things. Therefore, my pricing margin is now blank. And it's in there. So either they spread it out on everybody or they charge you for it and have a better price. So there's always some piece to it that you're paying for it one way or another. It just has to be part of the model that's being built. But
you don't get to tell them, you don't get to say, can you just wave this one for me?
Oh, I get that. Yeah, I get that occasionally.
Yeah.
Hey, listen, I'm a good guy. No, we do. We will work we'll work with our brokers. So we figure it out. We work with them. If there's an opportunity to get the loan back, that's great. That's why the conversations need to be had, for us. And if we're ahead of the game, it's much more likely you're going to have an opportunity to work with the lender. Some are strict. We're not as strict. I look at it. I look at everyone. We have to have contractually. You have to protect yourselves. So you have to protect it, but we'll go down and take a look at the true profitability of the loan. We'll take a look at what the cash loss is going to be for us. And if there's an opportunity to lower that, we'll do it. Like we'll do everything we can to make it less painful because we get it. I mean, I've been there. There's nothing worse than having a great month and all of a sudden, you turn around and you get this bill. You're like, oh, you owe 12 or 15 grand back, like as an originator. So you're like, oh man, like what happened?
Well, it's funny. I know you guys work. I was talking about you going to the investors like, hey, by the way, could you waive this one for me? I know.
Oh, yeah.
I know, bro.
They don't even do that. They just sweep our account. They don't even get a chance to chat with anybody. It's just like ping, it's gone. They just take the money right out.
Mortgage brokers, and the only reason I mentioned that, I know part of it's us joking around, but the other part is serious. Trust me, I totally get putting food on your table, but you got to remember their food on the table too. If they can't provide for their families, if they can't provide for the people that work there, if things go south, that's not good for us. Then in turn, we're missing out because we're not getting the products, and it's not just one of us, right? There's a lot of us that leverage AFR, and not just AFR. All these other lenders that we're using all deal with the exact same things that he's talking about. So just keep that in mind. I know we're frustrated when we make those phone calls initially, but just please keep that slightly in the back of your head, understand it, acknowledge it, and then work towards a solution. Don't just say, I'm not paying the CPO. That's not how things work. Hey, I hear you. I know you guys are losing money on this. I am too in turn. I know I should have set the client up better. I know I should have managed expectations better. However, I'm hoping you can work with me on this. That's a different way to start that conversation as opposed to saying, fix this or I'm done. I'm never sending you a loan again. Less likely to probably get some help, if that's a fair statement that I can make, hopefully, Rob.
Yeah, boy, that's a fair statement. And it's honestly, at times I wonder, from a partnership perspective, like tone means a lot, and like just working with us, or if it's going to happen prior, let us know too. Like if it's one of those like, man, this one is like, I don't know, how do I structure this where like he might pay off, like he said something, and we all had those conversations. Listen, I've been there, I've lived it. The guy would be like, I'm selling my house. No, I'm gonna keep. Well, yeah, I think I'm gonna keep. Well, maybe I might, and you're like, wait a second, are you paying this thing off or not? Like you had that, you kind of are implying you may pay the thing off. Just let me know. And that's the part, is communicating is everything, and tone is everything. If it comes up, again, we'd much rather figure out a way to make it work for everyone. Nobody wants to have these conversations and do this stuff. This is math of, if you want to have the best pricing on the planet, which is what I want to provide, I need to find a way to, when there's losses, to recoup some of those losses, and that's it. That's the only way I can put the best price out there.
So I want to talk briefly about premiums before we wrap this up and the way premiums work. And I'm curious on your side from the broker space. So from us to you, when you're when people are calling you or you're talking to the community, what are people saying when they see the premiums moving and their premiums going down, going up? How do those conversations even start with you? Where do you even take those? How do you start that conversation?
In terms of like loan premiums?
Yes.
Yeah. So in loan premiums, it's interesting. So we talked about before about like the
Yep.
varying amounts of premiums that are out there, and there's some anomalies in pricing that we're seeing right now. So in general, like there's sweet spots where there's more premium, and there's a reason. And I think
Yes.
a lot of people don't quite understand I don't know. Sometimes let's use a government example. Like 675 will pay more than 6875. In fact, 675 pays more than like 7 today in note rates. So you think there's this kind of continuous move incrementally higher as the higher you go in note rates, but that's not the case. There's a diminishing return at the top of the note rates. We talk about that's why retail had to change their model to get more competitive, is because they were living at the top end of the stack in their rates, and sometimes they didn't even have a rate that was undiscounted. They would always have a rate that had a discount point on it. So in terms of premiums, you start to see this amount. The investors just don't want to pay. They just don't want to pay for a loan that potentially could pay off quickly. So nobody wants to pay 6% to buy a loan that's earning 6% interest or 6.5% interest and have that loan pay off when they could have just bought a treasury. So you're battling a different vehicle for investment. And that's how you have to think about this. People are buying this as an investment tool for yield. So how much premium is going to, and what note rate and how much premium they pay is going to determine the yield that they're going to receive on their investment. So if I'm battling against a 5-year, 7-year, or 10-year treasury that has guaranteed payments, and this one I'm paying a premium, and I might make a little more, but I also could get this thing paid off and not make any of my yield. Like there has to be a certain amount that there's a level where they're just not going to pay anymore, especially higher up. So as the higher you go up in coupon, you start to see that there's a diminishing return because there is a higher likelihood that higher note rate is going to pay off. Therefore, it pays less, which then in turn makes you pick a different lower note rate. And the same thing happens with mortgage servicing rights. The higher note rate it is, and we talked about before, the value of servicing right between 7.5 and 6.5, maybe 50 or 60 basis points. You start to see that. That's why when you go higher in the stack, sometimes you see, rate sheet from Friday, 7.5 note rate pays less than 6.75 today or on Friday. So 7.5 has such, even though it's much higher in rate and it's 75 basis points higher in rate, but investors think that is not as valuable and they'll earn yet less yield at that rate because they know what's going to happen immediately when it's eligible. That thing's gonna turn and refinance because they can refi like right when the 6 months or 7, if it's VA loan 210 days, like right away they can refinance that one without anything happening in the market because you were so elevated there. So investors are now catching on to like, hey, premiums are gone. There's less foreign investment in mortgage-backed securities. You're not seeing like the way it used to be where like Japan and China were buying so much that you like they were bidding against the Fed too on securities that are being purchased. So like things were getting elevated in premiums. That just isn't the case anymore. And that's why you're like struggling to see those higher premiums or note rates that pay, especially if there's loan level pricing adjustments that pay through LPC and then have any credit back to the borrowers. Those are few and far between.
And the reason I love it too is this is the biggest difference. When people talk about, we talked about it earlier on during COVID, I was getting 104, I was getting 102, I was getting 103. It's like, we get it. But right now, it sounds like these investors are getting smarter. It sounds like they're actually, wait, we now know the game more than we ever have, especially with companies that are really good at, I don't want to use the word churning. I don't think, I think churning has slowed down a little bit compared to where it used to be. But especially these companies that are really good at retaining and have really good recapture, these investors are watching these loans get paid off in almost a cycle, right? Where they're like, they know this is 6 months, they know this is 12, so we're not going to pay the same top dollar anymore. Rob, I know we're getting close here to finalizing our session 1 of this 3-part session, which is such a big win for the broker community, especially just understanding more. And as the broker market share grows, it's really important we know how to educate people that are coming into our space. But there's one more thing I want to touch on. You were talking about premiums and you were talking about certain pockets and opportunities that we might be able to hit. Can you elaborate on that and what you meant by that?
Sure. In the world today, there's that premium amount. There's something called the TBA security, and it's to be announced, and it kind of sets a baseline. It's like a price maker. If you're out in the like stock market world, there's like a baseline price that no matter what, you're going to get this particular price for a type of loan. Now that implies all of the loans that can fit into that particular coupon or bucket, but there is opportunities here and there where you can gain additional premium by packaging loans that can outperform a standard security. So, and when I say outperform, that means it'll a less likelihood that it's going to pay off quickly. So, a good example is lower loan balances, and you see that with our pricing out there. We price pretty aggressively. That's because we're passing through the fact that if a real baseline example is that if you took two $500,000 loans and put them into a pool, and then took 10 $100,000 loans and put them into the same size pool, $1 million pool. If rates moved 50 or 75 basis points, there's a very, very good chance the two $500,000 loans are gone.
Yes.
However, if you spread it out and did those $100,000 loans, that's 75 basis points, only like $20 a month, $30. Is it really worth refinancing? So let's just say one refinances, and now you have $900,000 left in this pool. You have zero in pool two. So when you have that happen, someone's going to look at that and go, I would rather pay more money for the $100,000 loans. So I'm going to give you an extra 100 basis points or 200 basis points. Now that goes all the way up, and there's all different buckets that you do this with. And that is called specified pools. So you have these specified pool pay-ups. So if you can package up loans that have criteria that aren't going to pay as fast, it used to be a very small amount of the market, and now all the way up to like $300,000 or $350,000 loan balances can be pooled with like loans and get a little additional premium. Now, most companies don't pass that through. It's very difficult to do it. It is a pain in the ass. To be honest, my rate sheet's crazy, and I talk about it all the time. I have all these different note rate adjusters, and people wonder why the hell I have this note rate for this program, and why is the 7 paying more for that type of loan than the 7.25 or 6.5 even. So when you have all these different anomalies in the loans themselves, we pass that through our rate sheets to try and get that and get more of that business in. The more of it that I have, the better chance I can slice and dice and make additional margin on those loans and pass through better pricing. So it's a win-win for everybody. And stories today, we call them stories. When you package them up, you're going to see a lot of it. And one of the big ones I wanted to mention was in the government space. Like we had that little dip in rates, and we saw VA loans like rip, like in terms of speeds, they ripped. They paid off so fast. And so people are like prepping and waiting for rates to move down to really attack the VA borrowers, and because it's just really easy to refinance them. Where FHA loans are more difficult, and USDA loans are just harder because you can't go above a certain loan amount for FHA. You know how you have your streamline rules that are in place. Now, if rates move down far enough, it makes a lot of sense. Or if premiums go up, it makes sense to do streamlines. But as it stands now, it's difficult. It's not as easy as a VA loan. So you're starting to see stuff where you're going to see more and more of it. We've been talking about it for months. It's that VA pricing is starting to get a little worse than FHA pricing. So I can package up a loan pool. And if I took a loan pool and I did all of it as FHA and had no VA in it, I can get upwards, 75, 100, 150 basis points more in price for that pool than if it had even just 30% concentration of VA. Not even all VA, just if it had 30% concentration, I can't get that type of pickup. So there's these different pockets out there in specified pools that you can create, get a little bit more premium, not to the big numbers that we had in 2020, obviously, but now it's like investors are savvy and they want to know what is the story and can that actually show up in the models and show up in the investment. And that's something that it is really hard to pass it through, but we found a way. We found a way, and we're going to continue to work on it. As more stories come up, we keep passing it through to the broker community, and we want you to know about it. And sometimes it does make sense to take a look at the loan balance levels and see where those adjusters are. So when you're moving your loan amount, or if there's an opportunity to, slide down a particular loan bucket, take a look at those adjustments, and you may have an opportunity to drop a loan by a few $100 or $1,000 and get a much better interest rate or get a better premium on that loan just by doing so.
So if I'm a mortgage broker out there and I'm partnered with AFR, and I'm listening to this and I'm going through the process, what would it feel like to you? And you tell me if you think this is a better way to do business or not, and genuinely asking where it's like, hey, no, John, just focus front end. Actually, that's where I want to see brokers. But if I'm calling your AEs at AFR, I'm picking up the phone and I want to market. I want to get in front of certain borrowers. I want to get in front of certain opportunities. And instead of calling your AEs and say, hey, I need better pricing, and I call and I say something like, hey, I know there's sweet spots that you might have inside of your rate table because of the way that you guys package and sell off these stories. Can you walk me through what those sweet spots might be? Do you believe that opens up for better conversation between us and your AE? Or do you think, hey, you know what? It's something where just talk about the rates. We're not going to really get anywhere with it. How does it make you feel if we did that and approach your AEs that way?
No, that's you want to do it. That in our
Okay,
portal
cool.
too. So our portal communication, you want to have the conversations of like, hey, what's hot? Like we hear, Pieklo talking about crap all the time on podcasts and other shows and other stuff about this. Like, what is the execution, and where is it, and what can we market to? And is it something that's going to be around for a while? Like this investor story is amazing. I'd be pushing this out as much as so many loans were done on the investment side in the sevens, in the high sevens, even low eights. And there's a lot of loans sometimes that got moved into a DSCR loan. They qualified conventionally, but it was just easier and the rate was a little higher. Now they may qualify conventionally and go down. So there's like these pockets that we have opportunities for. And you always want to be talking to the account executive and logging into the portal. You have our banners. We send emails and stuff. I know not everyone reads all the stuff that's out there, but pay attention to it. Now, specifically though, for brokers in general, or specifically I should say in government loans, I don't care who you're working with. How a lot of the pricing engines price is not great. It's very difficult to see. And I say it all the time, brokers, please open up the rate stacks and look at the price. Just look, because I see them. I mean, I see a lot of them, and holy cow, if you just opened it up, you would realize that the loan you picked and tried to move forward with, you can go down a significant amount in rate for just a small amount. I mean, we're talking, you can drop sometimes 10 or 15 basis points in price can get you a half better in rate. And I wouldn't call it out if I didn't see it every single day that we've blindly gone through and looked at an investor stack and note rate and just picked and didn't open up that stack and really look at it. And each investor may have a different thing, and you can always pull and run things by a desired rate. I strongly recommend running by a desired rate if you're in like an Arrive or something like that, and then opening up the stack to see if it is the best within that lender, and test that out. We see it every day. Open up the stacks, find the anomalies, and you'll see it most often in government on the quarters. So you'll see it on a 6 1/4 or 6.75 or 5.75 or 5 1/4. Hopefully soon will be a 5 1/4. But so if you'll see it there, that is the sweet spot for brokers to take a look and see that there's going to be anomalies in pricing there. And then on the conventional side, you'll see it occasionally on the 0.625s and eighths. You'll see it there based on how the coupon works and buy down and buy up grids. But in general, that's the stuff they have to look at. And outside of talking to account executives or whatever, but just our job function to provide the best loan for the client is to open up those stacks and make sure you're pricing and looking at things as apples to apples versus what we're seeing a ton of people do, which is apples to oranges.
And Rob, the reason this is such a big deal too, it's so much deeper for the broker space as well. And look, some of you are saying, "Oh, I already do this." Wonderful. If you already do this, fantastic. More power to you. Keep doing it. If you don't do this, though, it's really important you take the time to slow down, because the data is the data. Mortgage brokers in the current environment that we're in, we don't do a good job at all recapturing clients. We own the purchase marketplace, but every year we lose in refinances. Even last year, mortgage brokers equated to 19% of all the refinances that occurred. Yet we have 28, 29% market share, depending on what you're looking at. So there's a massive variance there, which means that if you're not opening up these rate tables and you're selling a 7.5 when you can sell a 6.5 and it's better for you and the consumer, That means when that loan is sold, if it is sold, or even if it's not, if retail gets a hold of it later, you're going to lose that battle because you gave them a 3/4 higher of an interest rate simply because you didn't click a drop down button to look at the rate table. So this can go even further than just what he's talking about. This really plays a lot to do with just slowing down. Take a step back. What does it look like? Be the professional, be the advisor, find the sweet spots and educate the consumer. Y'all, this is I hope you understand the importance of this. I hope you all gain value from session 1. We have 2 more sessions just like this with somebody that knows it like the back of his hand. And more importantly, he's been where we're at not long ago. Okay. He's been in our shoes very recently, on the floor, trenches, writing loans. He's replying all the time inside of Brokers Are Best, just educating you. And even if you have bad information or bad news for him, he will be more than happy and willing to have the conversation with you. So this is session 1. Be prepared for sessions 2 and 3. I welcome my friend, Rob Pieklo from AFR. The new AFR has been coming back hot and heavy, helping the broker community every step of the way. Rob, I'm excited for session 2, my friend. Thank you for today.
Can't wait. Thank you. Thanks, Jonathan. Thanks, everyone.